This is Daily Market Rundown live from the Tradelo trading floor. It's February the 26th. Some highlights from today's show. Bets on a growth scale are now rising, gold profit taking is set to continue, and NVDA's earnings are now in focus. Coming into Wednesday morning, it is calm across the board. I say calm, not necessarily we're all clear from the recent risk off, but a little bit of calm, and we can see that across the Asian indices. We can see the Hang Seng having a very good update today, predominantly led by, of course, the tech indices. Now, if we go and focus, of course, Europe has taken the baton and followed on in that sort of vein, with the DAX now up 1.35 and the CAC up 1.16. We'll talk a little bit more about the DAX technicals in today's stream, so do stay for that. Looking, of course, at the bonds, they were a very early clue yesterday as to the risk-off afternoon we had, and of course, coming into this morning, we see a little bit of steepening. US bonds are a little bit offered this morning, but again, in terms of context, they're offered after a significant rally over the course of the last 4 or 5 sessions. So a little bit of profit taking, and like I said, it's not all clear. And again, we will reference the VIX in today's daily market rundown. With that being said, let's get stuck straight into it and talk about our first little bit of key news. This is effectively with regards to a bet that has been put on in the US 10 years, and it's relatively sizable. Just to discuss the bet, it's basically a $60 million bet that will stand to profit or win ultimately, should yields continue to pare back down towards that 4% and perhaps even lower towards 3.5%. So it's very much a recessionary, not necessarily a recessionary, it's very much a growth scare type play. If we were going to go into a recession, we'd be going a lot lower than 3.6% in terms of yield. So it's very much a growth scare type play. It's done in size. Does it mean that is the way the market's going to go? Of course not. What we want to take away from it, of course, is that there is this positioning in the market now. Okay, to put that sort of a bet size on does suggest that this is becoming a little bit more of a consensus type play, and that is that yields are going to be moving lower in the near term. Okay, so what that means is the market's going to remain of this narrative that growth scare is the thing we are dealing with for now. And again, I've referenced this in the last couple of daily market rundowns, but if we go look back at July, that's a fantastic playbook to lean on, because the growth scare started late July. Of course, it escalated as we had the very weak non-farms print at the start of August, and it was only until effectively September, when the Fed did the 50 basis point cut, that the VIX started to pare back and we started to see a little bit of confidence come back to the market. So what I'm leaning on is this growth scare narrative is likely to stick around until at least we have some key economic data. Now, that first bit of data is going to come in the form next week of both the PMIs and the non-farm payrolls. Now, should those come out stellar, should they come out amazing, well, fine, then yes, the growth scare narrative does get challenged. Should they come out weaker, well, then this growth scare bet is going to just keep escalating until such a point that we either get the really bad data or we see the alternative, which is very, very strong data print. So for now, it's very much this narrative stays in play, and it's not likely to go anywhere anytime soon. Now, this was posted to me by one of our traders, Daniel. He's got his new account in the Discord channel, so make sure you follow that channel. It's really great to see him posting his own thoughts there now in his own channel, so do follow. And he kind of brought this to my attention, and it was this idea of, what breaks the dollar. Now, I've been talking a little bit about this lately in terms of, what is ultimately going to give us that offer in the dollar? What's going to bring all those very aggressive bullish bets on the dollar? What's going to make them unstuck? Well, now what we can see is at a technical level, okay, right now we are very much sitting at a key support level. Okay, so it's going to take something fundamental to ultimately break the back of the dollar, and I suspect where that comes from, and this is the chart Daniel brought to my attention, was it's going to come from the curve. Okay, now we've got the curve in the green. This is the 2 cents curve, and I want to draw your attention to what we did when we started to see that growth scare in July, August, and September last year. You can see the curve steepened quite aggressively from, call it negative 40 basis all the way up to around positive 20, so around 60 basis points of steepening. And at the same time, if we look at the dollar index in orange, okay, we dropped from 106 all the way down to 100. So call it a 5% drop in the dollar in the space of 3 months. Okay, why was this the case? Well, what happened in that growth scare was initially, okay, we could see that we got this little bit of flattening. Okay, so the weaker data actually started April, May, and June, and we can see that flattening taking place, identical to what we're having now. a little bit of slowdown in data, curves flattening. But eventually the market says, well, this slowdown in growth is going to force the Fed to cut. And it's when we get that pricing that starts to come, the curve's going to steepen out, exactly like we did July, August. We're going to get that steepen on, and that's going to give that very, very aggressive offer back into the dollar space. Now, we can see already, if we look at the purple curve, that is effectively the pricing this year for rate cuts. We can see a little bit of movement there. We can see that slowly starting to tick up. Again, I want to reference, if we look back in late June, we could see it tick up, it moved sideways, and then it went very aggressive, and at the same time we got that dollar sell-off. Okay, the point is that dollar sell-off is coming. If there's a growth scare, dollar's going to get whacked, and it's going to get whacked across the board, whether you're long euro, long pound, long Aussie, long yen, long Swiss. They're all going to rally up against the dollar, but the timing of that is what matters, and it's all going to boil down to that curve. So watch the curve steepener. Of course, the moment I see it, or Daniel sees it, or any other trader sees it in the Discord community, we will post it. Okay, at that point, don't be buying the dollar. If anything, look for those aggressive shorts of the dollar. Why? Because the entire Wall Street is long dollar this year. They're all expecting a much stronger dollar. Now, with that in mind, let's turn our attention, talk a little bit about gold, that shiny little metal. And I think this is an interesting chart to look at because, of course, gold's trend is firmly intact. Of course, gold is significantly strong, and that trend's not about to change anytime soon. But that doesn't mean we don't get corrections. Okay, I think we are in a corrective pattern now in gold. We'll discuss, or we'll zoom in a little bit to this chart in a minute. But what I want to draw your attention to is how far away we've rallied at the start of this year, but more importantly, we are not even close to any of our key moving averages. Okay, we're still sitting around $30 above the 20-day moving average. And what we typically see, if you go look at this sort of a chart over time, what you typically see when you get these extended moves is that they do need to pause at some point for the market to consolidate. Okay, and I think that's what we've got here. We've got a pattern now where I suspect the market's going to consolidate. It's going to allow a little bit of time for these moving averages to catch up, but I do suspect gold's got a little bit more downside in the near term, perhaps all the way down towards that 28.50 mark. Now, where does that level come from, and why do I think we have near term short side opportunities? Well, it comes down to the structure of gold. Okay, what you've seen in terms of gold was we became very top heavy over the course of the last 4 sessions. Like I said in yesterday's daily market rundown, that flush out was always on the cards. We got the flush out. This morning, effectively what we've done is we've tried to come in and retest that 5-day distribution. We failed there. It got very quickly sold off. I'll show that to you in a minute. Got very quickly retraced off of the 29.40s. So I suspect we are now going to come in and test around this 28.90. Now, there's an expression in sort of profiling, if you've ever done market profiles, that typically for markets to move, in this instance, higher, we first need to resolve lower. Okay, so in other words, what it's telling us is that this structure around this 28.90s, it first needs to get sort of washed out. We need to take out those sort of very weak buying hands, those very aggressive buying hands, and once we can resolve that, once we take that out, then fine, then we can of course move back up and continue this rally at some point in the next couple of weeks. Okay, so it's very much a structural play this way. I expect the 28.87s get challenged, if not today, perhaps later on this week. They get flushed out, they get tested. We come in and test that 28.50, which is nothing other than the November highs. It's nothing special. What it will do is it will allow us to then get a little bit closer towards that 50-day moving average, which is going to come in somewhere around that 2800 or just below area. So on the futures, that coincides with around the 27.75 resistance that we left at the start of this year. So keep a close eye on. I think the key takeaway in terms of gold is that ultimately we do have some downside. Now, in terms of levels for us day traders, like I said, there you can see we very early tested in the Asian hours that 29.40. It was this sort of 5-day distribution. We failed there very quickly. Market came back inside that lower range. And so what I expect now is at some point today, we're going to go in and test those lows. And at some point in the next couple of days, we're going to flush this little level out. And once we do that, once we come back above that 28.90, fine, we lean on its support, and then we can stage the rally back up towards those record highs. Okay, now on that note, a very similar technical pattern is actually in the DAX, and I think the DAX and gold look almost identical this year. There is the DAX, same chart, same yellow line, same overbought territory, and this is why I'm a little bit, not bearish DAX, very much not bearish. It is the star outperformer, but very much looking to be a seller of upside rally, simply because I'm expecting us to consolidate here for a little bit longer before moving. Now, again, if we go and look at these types of patterns, we've got a nice little example in Q3. We can see how yellow line is our DAX, rallies aggressively. It then spends a period of 3-4 weeks consolidating. Okay, I expect the same thing from DAX right now. I expect perhaps a double top, a little bit more two-way trade inside this zone before we can perhaps continue this rally. So it's very much a rally that's extended quite aggressively, and I do expect some sideways consolidation. Now, how do we trade this? How do we execute this? Well, let's zoom in on a 60-minute chart because you'll get an understanding as to how I think this plays out. Well, we can see, of course, that we had a little bit of resistance around this red line of 22,650. We extended above it, but the market spent very little time above there. Okay, I think that was a very key little sell-off at 22,950. The market didn't want to be up there. It got sold very aggressively last week from that top, and we then started to spend time back inside this range between 22,300 and 22,650. Now, the key takeaway from here is I'm not just selling it there and there and there and there and all the way up the page. That's not how selling works. Effectively, what we lean on is little bits of structure. So we can see we've got some structure here. We can see this 22,650 has acted as resistance over the course of the last couple of sessions. We can also see that we had a little bit of stop activity above it, which means there was someone bigger than me very interested in that spot. So what I'm looking for is to let this market do whatever the hell it wants to up here. But once it starts to offer and gets back below that 2650, I'm looking to initiate those shorts all the way down into that Sunday gap. Okay, that is the play. Now, in terms of risk reward, if we think in that sort of way, we've got around 400 points of downside. And in terms of stop, we're not going to need more than a 50 to 100 point stop there. So call it 3.5 to 1, 4 to 1 risk reward, but we lean on this structure ultimately to short that trade. Okay, now hopefully you get an understanding as to how we tie in sort of the big time frame patterns with the more structural 60-minute patterns. That is how we find these areas of opportunity, and that's a lot about what we post into the Discord channel. It's these structure type plays where we've got good risk reward in terms of the trade opportunities. Okay, let's update on our VIX. The key takeaway we said yesterday was we were looking for this pattern of higher lows and higher highs. We've got that pattern now, and I expect more of the same today. Okay, I'm expecting us to hold above that 19 area. I don't think we're going to offer very aggressively below that 19, not until we get this growth scare resolved. Now, like I said, we've got some very key data points coming out, of course, at the end of this week with the PCE, but we do then move into, of course, non-farm payrolls next week. So until then, we are in an environment of a higher VIX level. Now, what that means, higher VIX, is it means that we have to be looking for short side trades in the equities. We have to always be looking to sell into those rallies. Now, it doesn't mean we can't have aggressive, ugly feeling rallies. Of course we can. Okay, we can very much have these types of rallies that make you feel like, OMG, this is going to go back up to record highs, and then suddenly they roll over in the same session. Okay, like I always say, volatility cuts both ways. That means to the upside and downside. A high VIX does not mean equities go down only. It just simply means that we've got the potential to have very aggressive rallies as well as continued sell-offs. Okay, now whilst we are, of course, in this elevated regime of VIX, the high probability play is that we will get some form of a continuation to the downside at some point. Okay, that is the logic around the VIX. Now, the key takeaway for today is just to watch how we trade in around this 19 levels. Like I said, we might extend a little bit low into yesterday's low, but I do not expect yesterday's lows in those VIX to go. Okay, I do not even expect it to get tested. Right? If it does test down there, by all means, I think that S&P will be substantially higher. But right now in the S&P, the key level is that 60 10s up to 25s. I suspect that holds. That is resistance. If we take that out, the next level is 60 48s. But like I said, to get up to those 60-48s, I expect you will need that VIX to be trading and testing into yesterday's low. So keep an eye on the VIX. It remains elevated, and that means we need to remain, of course, vigilant to further downside. Now, that being said, the key event of today is NVDA. It's all about NVDA. This is obviously one of the more important stocks to pay attention to in terms of earnings. We've had the Mag 7 come out, the likes of Google, Microsoft, Meta, and they've all told us we're going to keep spending in terms of CapEx. They've all told us there's nothing to worry about. But in recent days, we of course did see that report posted in the Discord channels all about Cohen talking about Microsoft canceling leases, which is very, very unusual behavior, sort of likening it a little bit to what Meta did last year when they quietly cancelled all their spend on the Meta universe. Now, I think the key takeaway to today is that any hint from the CEO that perhaps there is a little bit of a slope down in demand, any kind of word rhetoric that just hints at a slower than expected, okay, and the markets are going to absolutely go into a tail frenzy. I just want to reference this chart. Sentiment-wise, we are very, very negative in terms of equities right now. Okay, there is a negative sentiment contextually coming into this earnings, and that matters because any other day, if VIX was trading 14 coming to this earnings, I say to you, the earnings don't really matter. Okay, they can say pretty much what they want as long as they don't, completely downgrade expectations. It will be fine. However, today it's almost like unless they tell us something absolutely amazing, the reality is we're probably going to get a sell either way. Okay, just because of the context of the market. Now, expectations are there's an implied vol move in NVDA of around 10%, but I would like to think that it's perhaps a little bit higher than that. If we were to get a scenario where we do get Jensen sort of being a little bit downbeat or using the kind of wording that shows some concern around future orders. Okay, that's what it comes down to. If there is a slowdown because of DeepSeek and the whole, CapEx expenditure, if there is a slowdown coming and he does give any kind of a negative guidance, I can tell you right now, 10% is going to be the least of the worry for NVIDIA holders. Okay, I do suspect we come in and test around that 90 to 100 level, which give or take is somewhere around 10 to 20% lower from current prices. Okay, don't forget as well, it's very unusual, you should note this, very unusual that we've dropped, almost 12% coming into this earnings. Okay, we've had quite a rotation since last week's highs, so we are coming into this earnings with a down tape, which is quite unusual. Okay, NVIDIA normally rallies very aggressively into these earnings, and then most importantly, look where we're sitting. We are sitting smack bang on the 200-day moving average, and this is used by big time frame investors as a key guide. Now, what that means is, should you come in tomorrow, should the earnings be negative, should NVIDIA be down in the pre-market, trading around 110s, 112s, 108s, wherever it may be, what that means is investors are coming into the open with NVIDIA below the 200 moving average, with a gap to the downside, with sentiment very, very negative. And what that spells ultimately for the indices is further downside. And I think that's the key takeaway. That's why we focused on this NVIDIA. It does really much come at a time when sentiment is quite negative. That is it for today. And in terms of the data flow, we don't have a great deal of headline data. That does start tomorrow with some of the European inflation data coming out. And then, of course, the PCE out on Friday. In terms of what to watch for today, we do have some speakers, including Madame Lagarde. There's a great tussle going on in the ECB about how many more cuts. I'm not sure she's going to change her stance, which is right now we are focused on cuts and that's what matters. We'll discuss neutral rate at a later date. But of course, she is the governor. We pay attention. We listen in case she does drop a bombshell. If there are any other questions, post them in the Discord channel. Make sure you do follow our star trader, Daniel, in the Discord channel. Fantastic to have him posting his own thoughts. There's some great posts, of course. He has also posted about NVIDIA in the Discord channel, so go and have a read about that. If there are any other questions, of course, do post them. Otherwise, as always, good luck out there. Manage that risk. Go make some money.